Today I'm going to discuss accounting standard 11. This standard tells how to handle gains or losses when the exchange rate changes. AS-11 mainly deals three items: foreign currency transaction, foreign operations, and foreign exchange contracts. AS-11 gives guidelines how to record foreign transaction books which exchange rate changes, and how to show or present exchange gain and losses, and which exchange rate to apply. Next item, monetary items. Monetary items are those assets and liabilities that represent a right to receive or obligation to pay a fixed amount of money. The value is directly affected by changes in exchange rates. For example, debtors, creditors. Next is non-monetary items. Non-monetary items are those assets and liabilities that do not represent the right to receive or obligation to pay a fixed amount. For example, inventory, fixed assets. Next is classification of foreign operations. Foreign operations classified into integral operations and non-integral operations. First one is integral foreign operation. Integral foreign operation means a foreign operation whose activities are an integral part of parent company's operations. It operates more like a branch or extension of parent. Accounting treatment. All monetary items are translated at closing rate. Non-monetary items are recorded at historical cost. Exchange differences are recognized in profit and loss. Non-integral foreign operations. Non-integral foreign operation means a foreign operation that is financially and operationally independent of the parent company. It operates as a subsidiary, associate, or joint venture of a foreign company. Accounting treatment. Assets or liabilities are translated at a closing rate. Income and expenses are translated at average rate. And exchange differences are not taken to P&L account, but shown under the foreign currency translation reserve, that is FCTR in equity. Okay.
I am dealing with the topic basic aims of AS-11. First one, reporting currency. Currency in which a company presents its financial statement. Next one, second, foreign currency. Any currency other than the reporting currency. Third one, exchange rate. Rate of one currency in terms of another currency. Fourth one, spot rate. The exchange rate on the date of transaction. Then last one, closing rate. The exchange rate on the balance sheet date.
Today, I am going to explain the accounting for foreign currency transaction. The process can be divided into three stages. First one, initial recording of foreign currency transaction. Second one, extracting balance on balance sheet date. Third one, settlement of foreign currency transaction. Initial recording of foreign currency transaction. Recording the transaction on the date it happens using the exchange rate of that day. Applies to all purchases, sales, or paid in foreign currency. When a company buys or sells goods or services in a foreign currency, AS-11 says that you must record that transaction using the exchange rate on that day the transaction occurs. For example, if a company bought goods worth $1,000 when the exchange rate is 83, we record just 83,000. This becomes the cost of purchase in Indian rupees, so we always use the exchange rate on the transaction date for recording the entry. Second point, restating balances on balance sheet date. Under this, asset can be classified into monetary items and non-monetary items. Non-monetary items include cash, debtors, creditors, loan. Exchange differences shows us a gain or loss in profit and loss account. At the end of the accounting year, we check if the foreign currency rate have changed for items like receivables or payables. We must update their value using the closing exchange rate of that day. If the value increases, we record it as an exchange loss. If it decreases, we record an exchange gain. For example, if we bought goods worth $1,000 at 83 rupees, the value becomes 83,000. At the end of the year, the rate becomes 85,000. New value arises, that is 85,000. The difference between 83,000 and 85,000 become 2,000. It is an exchange loss recorded in profit and loss account. But for asset like land or stock, non-monetary items, we do not charge their value. Settlement of foreign currency transaction. Major points exchange gain or loss goes to profit and loss account. When we finally make the payment or receive the money, we use the exchange rate on that date. If the rate has changed since we recorded it earlier, there will be a difference. That difference is an exchange gain or loss. For example, amount payable ₹1000 recorded earlier at 83,000. Paid when the rate is 82, then we paid 82,000 at that time. We paid 3,000 rupees less, so we get an exchange gain of 3,000. Shows in profit and loss account.
Next, we are going to do a problem. The question is the exchange rate on date in which 24th March 2011 goods were purchased for USD 1 lakh is rupees 46.60. The exchange rate on 31st March 2011 is rupees 47. The rate on which payment is made, that is 5th August 2011, is rupees 47.5. Calculate exchange gain or loss for the financial year 2010 and 11 and 2011 and 12. Answer is divided into 3 steps. Step 1, initial valuation. That is transaction date. Goods were purchased on 21st March for $1 lakh. The exchange rate on that day is 46.60. When we multiply these amounts, we get 46,60,000. Then the generally will be purchase account debit to creditors account 46,60,000. Step 2 is transaction on balance sheet date. Here the closing date is 47. When we multiply 1 lakh with 47, we get 47 lakh. When we compare the transaction date amount with the balance sheet date amount, we get a loss of 40,000 rupees. That the loss must be debited to P&L account. Then the generated will be P&L account debited to foreign creditors account 40,000. Extent loss for the financial year 2010-11 is 40,000 rupees. Step 3 is settlement. Payment was made on 5th August. The exchange rate on that date is 47.5. When we multiply 1 lakh with 47.5, we get 47,50,000 rupees. When we compare the balance sheet date amount with the payment date amount, we get a loss of 50,000 rupees. That the loss must be debited to P&L account. Then the entry will be foreign creditors account debtor 47 lakh, P&L account exchange loss account debtor 50,000, to cash account 47 lakh 50,000. Hence, exchange loss for the financial year 2011-12 is rupees 50,000 rupees.